Hi, everyone. Mike White here. Welcome to this week's blog post. This week, I want to just share a quick tip and some strategies of some of the things I've run into and some of the things that are helping my people move forward. And while people are looking to buy houses or people are getting themselves prepared to enter, or while they're looking, things that they can be doing to overall lower their cost of their monthly payments. And this week I've called it the fact that credit, it's not just about the rate. It really goes to the point that we all know that credit scores do really impact the cost of borrowing. We know that based upon somebody's credit score, the gap between a 620 credit score where they can actually get approved for some loans all the way up to 750, 800 and above. There's a huge difference in the pricing and even the programs that they might be able to qualify for. And I think it's a bit of a struggle, not only with the consumer, but even for mortgage professionals themselves. Last week, I was at an event with a room full of mortgage professionals, and I asked them what they thought the average credit score was here in the United States. And I heard everything from 640, 650, all kinds of numbers like that. And it was kind of startling to me that nobody was even close to the fact that, Experian, and now I'm using a bureau where many of us are, they're part of the credit scores that we're using for people to get their loans. Experian stated that at the end of February of 2022, the average credit score in the United States was 714, which was a record, and it has been going up steadily in recent time. And the fact that now looking at this and people shaking their heads, not realizing that anything below 714 is now below average. That person who thinks that 620 credit score is good is 93 points below average. So guess what? The fact of the matter remains is your pricing differential on that house really changes. And when your people are concerned about what their interest rates are, you see it today. You can drop in somebody with a marginal credit score and find another consumer who's basically the same borrower, except their credit score is significantly higher and the pricing comes back. It's huge. And there are some programs, and I know that borrower can't get in front of because of a low credit score. There are some programs and some loan to values that you can't qualify for with certain low credit scores. But that's not only the issue, because yes, the cost of borrowing that mortgage or the rate for that mortgage is important. The loan program that they qualify for is important. The loan to value that they're able to get is important, but take into consideration what's the ability and the cost of PMI to somebody depending upon their credit score. What's the availability or the cost of homeowners insurance to somebody who's got a lower credit score? And the point I'm trying to make here is pretty simple. We can't control the interest rate market, but we can do something to help our clients improve their credit score and understand the value in doing so. How much money can they save by improving their credit score to get the same thing, the same loan, the same cost, the same MI, the same insurance, same exact thing? The monthly payment can be $50, $60, $100 or more a month difference, depending upon the loan size. If we were saving people money on their interest rate, we'd be reducing their principal and interest payment. If we were saving money on their MI, we'd be saving them part of that MI payment. If we were saving money on that homeowners insurance policy, they'd be saving money on that monthly payment. And it's imperative that you guys understand this and think about where is the video that you can do explaining the pricing differences and availability of programs for people who are looking for loans between 620 and 800. Where is that video that you could do from your personal experience in pricing differentials and what that translates to the average loan in your market, to the average consumer in your market, the average person that you're doing loans for, or your prototype borrower? How does that impact them? More than that, where is the conversation with your MI rep, right? Many of these PMI companies have reps that are more than happy to do a video with you or a Zoom call with you, do a live training with realtors in your marketplace, or maybe others, or at least be able to record sessions that you can have, that you can share on social media or put on your website, that explains the difference in availability and costs of PMI based upon credit score. And what does that translate to every month? And how does that impact the amount of money that they can borrow, and as a result, the offer that they can make on the next house? The same thing holds true with sitting down with your insurance professional and having the same exact conversation. What's the impact of homeowners insurance pricing based upon credit score? There are tiers of pricing, just like in the mortgage industry. Different credit scores have different availabilities for different types of homeowners insurance and different costs associated with those policies. So if you're really looking at the marketplace right now and people are complaining about the price of houses, which we can't control, and interest rate environment, which we can't control, but we can reduce costs. And something as simple and something that we should be doing at the very beginning when we first talk to people is anything that we can do to help them improve their credit score, even if it's just a little, can have a big impact. And you guys know there are people that come to you that, we do improve their credit scores, and some significantly. But it doesn't just show up in whether or not they qualify for a loan or a loan to value. It shows up in their PMI. It shows up in their homeowners insurance. It shows up. And that can be very helpful to people. And it's also a different conversation than what other people are talking about. And it's about controlling the things that we can control, and understanding that some costs we can help reduce by simple efforts. And by the way, isn't helping somebody improve their credit score beneficial to them in all other aspects of their life? Now you have even more reason to talk to them about it, bring together some other professionals with you, share the information, because the other guys are not going to be doing that. The other guys may not even know any of these things. The point that I'm trying to make here is, why not make your borrowers the best they can possibly be? The answer is pretty simple. You should be doing it. You should make them aware of it. Doesn't mean they're going to do anything about it, but it's up to you to make sure they have the information. So I thank you for your time this week. As always, if you have questions or comments, it's Mike at imtcoaching.com. Love to hear from you soon. Take care.